To what?
63.
How much is it down from its peak?
Since when?
From its peak, in the last 12 months. How much is it down? Where is the ounce of gold? Where's it trading? The quicker you get to it, the more information you give me, the higher points you get.
It's up 6.8
To,
2,246.4.
is that correct?
1,246.
Thank you. And then where is the, what's the percentage change from the peak to where oil prices are today? What's going on right now in the Straits of Hormuz? Didn't Iran just threaten that they were going to close the Straits of Hormuz, where 30% of the oil goes through? Is that a problem? Yep.
Down 20.
Where's the 10-year Treasury yield?
Almost 3%.
3% or 300 basis points or 30 basis points? Where's it trading?
2.90.
2.9. And where was it? Where was the peak? What was the peak? It was like what?
3.14.
Around there. I think it was a little bit higher. So how many basis points has the 10-year Treasury dropped? 25 basis points. What would be the number one factor that would drive long-term interest rates down using the Fisher equation? I'm just going to ask the questions over and over again until I see who actually gets it. So what would be the number one factor that would drive long-term interest rates down using the Fisher equation? Say it louder.
Inflation expectations.
Thank you. And then where is the dollar to the pound, dollar to the euro right now? And what's the number one factor that's affecting the pound? Brexit, excellent. So where's the dollar to the pound trading?
Dollar to the pound is currently at 0.88.
Can you turn it around?
1.27.
What is it?
1.27.
Is it up or down?
It's slightly down.
Slightly down.
So if it's down, did the dollar appreciate or depreciate?
Appreciated.
Excellent. And what did the pound do against the dollar?
Depreciate.
Excellent. Anybody have a makeup presentation?
Yeah.
You do? Okay, you ready?
We're actually waiting for.
Okay. Has everybody reviewed their grades so they know what their grades are? I only have an issue with a few people that are outstanding. She's not here. Vincent in this class, Logan, Camilla, Caitlin, Patrick, O'Shea, Emilio, Thomas.
Wrong class.
I know, I'm just going through the list.
Okay.
I have a consolidated list. Hunter Payton, Shelby Perez, Kevin Sadri, Jacob Templeton, Joseph Varnish, and that's it. Okay, everybody else okay? Can you please come? And if you have any work, can you pick it up from me, please? I'm not going to carry it around for another year. Okay. We'll do the Big Short in a minute. I'll do that as the last part of the class. Anybody need a movie review worksheet? Get your movie review worksheet. Bring your movie review worksheet. Did you not watch the movie at all? And then I'll take the liberal 3 at the end. Okay. Did everybody get an agenda? Everybody got an agenda? Felix, did you get an agenda for today? Okay, awesome.
Jeff, any still continue?
And then when you guys are ready, when your other team member comes in, let me know when, oh, you're ready. Are you guys ready? Yeah, okay. Why don't you pull it up on this computer here and I'll keep my agenda. Anybody else? What's the last name?
And then
I don't know.
I'll say the exact.
And then, as to the agenda, I'll let you guys work on your stuff, or you can work on your stuff. We're doing the presentation in the movie. Okay. So, there's some Stolen, that's really good. I brought you some butter, there's some pumpkin pie, and there's some apple pie there too.
Is this a donut?
It's called a stolen, it's really good. It's, just cut it open, throw some butter on it, it's amazing. It's a German, holiday bread. It's killer, it's not eaten up, and it makes some really good French toast. Yeah, it's pretty amazing. And just slather some butter on it, you'll be good in a second. Tell me when you guys it's like raisins and dates. It's really good, it's really expensive.
That's why it's still.
It's also different here too. Oh, I do have some more stuff over here. Vinny,
Had too many snacks.
Vincent, Anthony,
So
Olivia,
And like 500 calories.
Thomas,
oh my God.
Blake, Heathcote. It should all be. Hey, you ready? Okay, oh, we have a presentation, excellent. Well, I thought we were doing the chapter stuff. This is more fun.
Hi everyone, we're group 2 and this is our presentation. So I'm Meg, I'm the marketing manager. This is Claire, she's our team leader, and Shelby is our financial advisor. This is just an overview of some of the topics we'll cover this morning. And then this is some background into the Goldman Sachs company. So they're publicly traded, they're traded on the New York Stock Exchange, founded in 1869. They're an international company and they are a very wealthy company. As you can see, they've got $916 billion, is that right? 916,000 billion in assets. So, yeah, so I'm going to pass over to Claire. Shelby.
Okay, so this is Goldman Sachs' vision to be the advisor choice of their clients and leading participant in the global financial markets. So their leadership is, their chairman is Lloyd Blanke. Their CEO and chairman is David M. Solomon. Their chief financial officer is Stephen Scher. Their president and chief operating officer is John E. Waldron, and their vice chairman and CEO is Richard Node. And their vice chairman and global co-head of the investment management division is Timothy O'Neill. So some of the products and services they offer are institutional client services, investing and lending, investment banking, and investment management, which institutional client services contributes about 74% to their revenue. So SWOT analysis, some of their strengths are they have high customer service, they have global reach, and good operating performance. One of their weaknesses is they decline non-interest revenue, or there is declining non-interest revenue, decline in net interest income, asset quality is poor, and fraud and bribery cases are prevalent. Some of their opportunities are corporate tax cuts in the United States. There is a positive outlook on global investment banking and brokerage market, and some of their strategic initiatives. Some of Goldman Sachs' threats are regulatory changes, lower interest rate environment, additional capital requirements, and intense competition. And by intense competition, we mean this. Some of their financial conditions, Goldman Sachs return on equity is 5.1%, which we deemed as good. their return on assets is 0.4%, which we deem as excellent. Their net interest margin is 22.4%, which we thought was good. Their asset turnover is 0.1 times, which is also good. Their debt to equity is 4.1 times, which is poor compared to JP Morgan and their peer group, which fall a lot lower than 4.1. Their PE ratio is 17.6%, which we thought was good. And their 3-year revenue growth is negative 2.7%, which is above average. And their 3-year stock price approximation is 10%, which is good, which is overall good. A couple more. Their dividend yield is 1.6%, which we thought was excellent. Their revenue, got lost the word. Their revenue predictions for the next 3 years is negative 0.03%, which we thought was excellent. Their operating income for the next 3 years is predicted to be 2%, which is good. And their dividend yield for the next 3 years is seen to be 12.8%, which we thought was above average, which is overall good.
As you can see, over the past 3 years, Goldman Sachs has an upward trend in their stocks. They have a premium of 16.1%, and their target stock price is 270, which they're slowly achieving, and therefore you should invest in them. So using the perpetuity model, we use the CAPM model, and we use the 9% return on equity, just because it's the median range, and we got the intrinsic value of 216.1, which is higher than the current stock price. Using the Gordon growth model, with the same CAPM model and a premium of 18.8%, we took the 9% growth rate with the 1% using the median range and got $243.1, which is again higher than the current stock price. And we use the multiple approach. We use the multiples 11, 12, 13. We took the median approach again with a premium of 14%. And got the intrinsic value of 233.4, which is again higher than the current stock price. So with the last valuation model, we use the discounted cash flow, and we again use the median range for our calculations, and we got the intrinsic value of 242.34, which is again higher than the current stock price. So we used the weighted valuation of the second row, as you can see, the 5% for perpetuity, 5% for golden growth, 40% for multiple approach, and 50% for the discounted cash flow, and we got the intrinsic value of 237.5, which is much greater than the current stock price. So our recommendation is to buy.
So yeah, just summing it up, as Claire just mentioned, we would recommend that you buy it. And then these are our references.
Thank you. If you want me to give you some comments on any of the formatting, that's fine, unless you've gone to production already. There's maybe like 3 little typos. All right, so let's do the, we're going to save the big short to end. I'm going to do the course review. I'll spend maybe 15 minutes on what we accomplished over the semester, and then I'll give you the exit lecture, and then we'll do the movie. You'll give me your deliverable. I'll deal with any issues, say goodbye, start crying, tears, because I don't know, some of you I won't probably ever see again, which is one of the sad parts of teaching, but hopefully you'll look at me as a resource and we can continue our relationship going forward. I always like to end the semester with a celebration, so you're all invited to the Metro from 1 to 3, which is in the parking lot right across from Whole Foods on Mount Diablo Boulevard. We usually have a pretty good time. I invite my friends, I invite my former students, my current students, and I just think it's kind of a nice thing to do, you know, at the end of the semester. So let's do the course review. Okay, what did we accomplish? What did we cover over the semester? Well, the first thing was, which I really like to focus on, which I think is extremely important, and you're going to be asked these questions when you go in for the interviews, is what's going on in the current marketplace. They're going to want you to know about current events. because strategies and tactics and operational decisions all revolve around what's currently going on in the marketplace. And there's a lot going on right now in regards to trade and what's going on in the Middle East and in Argentina and Brazil, and what's going on in Paris right now, and what's going on in London. Excuse me, just let me focus. So it's extremely important because it's going to affect your markets, it's going to affect your capital, it's going to affect your stock price, it's going to affect your career. So it just is really important to track these markets. And that was really the exercise with the memo, was to not only start tracking the markets, because you're going to be managing maybe portfolios, mutual funds, ETFs, maybe individual stocks and bonds of your own wealth, and hopefully you will accumulate it, and your grandparents and maybe your parents, if you're lucky, will probably leave you an endowment of these portfolios, and hopefully you will either have a really good advisor to help you on that, or you'll have to manage these yourself, because if you don't, you're going to lose it. And that'll be kind of my theme in the exit lecture, is if you don't take control of your academics, your career, and your wealth, you're going to lose it, guaranteed. Okay. What else did we do? We looked at the first thing we did was we came right out of the chute and we reviewed the quantitative analysis, the statistics, which is extremely key for anybody who's in marketing or entrepreneurship, for digital media or finance or accounting. It's all based on statistics and your ability to collect data, filter it, clean it up, apply models, get information, and make decisions very decisively and very rapidly. And now with big data applications, we can collect data on an ongoing basis in continuous time and make decisive decisions as the markets change very quickly. So it's a different environment in which you operate. You're more responsible now, and I think the expectations from you in the work in the career and in corporations is they expect more from you. So they really want you to understand this stuff. So we talked about large data sets, normality of the data, how to calculate geometric and arithmetic means, the problems with arithmetic means, such as outliers, looking at different types of distributions, central tendency, mean, median modes, data analysis, data observation, data visualization, looking at volatility and risk, variance, standard deviation, not only from the individual stocks, but also in a portfolio context. We looked at model variable tests, F-tests, T-tests, using multiple regression to build forecast models, using both cross-sectional and time series models, looking at the coefficient of variation and being able to flip that and get a risk-adjusted rate of return, i.e. Sharpe ratio, looking at the covariance and the correlation. If there's high correlation of covariance, you're not getting diversification within your portfolio, either products or services or divisional lines or bonds or stock portfolios. You're just not getting it. We looked at multicollinearity that's embedded in a lot of the models. You have more than two variables in your model that are highly correlated to each other. You don't need two. You got to get rid of one. You get rid of the one that's not been cited the most in the literature and based on theory. Internal and external validity. You need buy-off internally by your board of directors, your senior level managers, your supervisor, the investment committee. You need buy-off if you're building any kind of model. That's the internal validation. Plus they will help tell you what variables should be in the model based on their experience. And then external validity is going to the library, looking at the research, looking at industry research, looking at the peer-reviewed journal articles, and basically externally validating your model using outside research. Systematic and systematic risk, political, economic, market risk, you cannot diversify away. You can diversify away company-specific or business-specific or real estate-specific risk by adding more assets to the portfolio whose returns have low, no, or negative correlation with each other. We looked at financial ratios. If you're an investor, I want to know ROE. I want to know ROA. I want to know debt to equity, debt to total market cap, interest coverage. I want to look at those and compare them against the peer group in the industry to see if my firm or the firm I'm looking to invest in has good overall fundamental, has an overall sound, overall financial condition or position in the marketplace. We talked about cost of capital and discount rate, construction and applications using the WACC, which is weighted average cost of capital, depending on the capital structure of the firm. And we looked at the capital asset pricing model, which you all know is the risk-free rate plus the beta times the return on the market minus the risk-free rate, because you memorized that. We looked at the perpetuity model, Gordon growth, multiple approach in the discounted cash flows applications to calculate intrinsic values, and then use those present values for capital budgeting and decision making, focusing on the net present value. The quiz, we looked at unorthodox monetary policy and the effects on discount rates and really asset prices. The yield curve inverted yesterday, okay? I've been talking about the yield curve inverting for probably 3 to 5 years. It's finally happened yesterday, okay? It has actually happened in April too, and it's inverted in some global markets too. It's coming, okay? It's coming. The yield curve dynamics we looked at in the dynamic yield curve, we came to the conclusion that if the yield curve inverts, the stock markets are gonna peak within 12 months, and we'll be in a recession within 24 months. That predictive capability goes back 150 years, goes back 70 years, goes back 50 years, goes back 30 years, and has been one of the #1 predictors of recessions. We looked at market indicators and the factors impacting these markets. What is the theory behind price movements in stock prices and oil and gold and bond prices and currencies? We looked at all those factors by laying out the dynamic supply-demand analysis. What are the supply and the demand shocks that would actually impact the valuations of the currencies, the price of these major asset classes? We looked at financial product innovation, design, development, engineering. We looked at S-curves for the technology curves. We looked at product adoption cycles for new product development. And if firms can do these consistently over time, they're going to create a revenue path. And the analysts are going to be able to identify those revenue growth paths, and they're going to apply the Gordon growth model. And if they can maximize the growth rate in the Gordon growth model, they're going to maximize the value of the firm. That's how we think about things. The quiz continued. Fundamental institutional foundations and factors driving innovation and requirements. You have to have an organizational structure in place. You have to be monitoring the markets constantly. You have to have flexible, agile, creative, innovative people. Internally, you have to have charismatic leaders that can lead the innovation, and then you need to be able to execute and bring those products to market as quickly as possible to meet the market demand and beat out your competition and maintain market share over time once you got them locked in. We looked at modern and postmodern portfolio theory. We laid out the utility curves, the efficient frontier. We looked at how to move up the efficient frontier and down the efficient frontier by increasing or decreasing allocations to stocks and bonds. We could jump off the efficient frontier onto the capital allocation line, either through leverage or lending, which has been done. We also included alternative assets such as insurance, real estate, and alternative renewable energies to the stock bond portfolio that bowed out the efficient frontier. We also bowed out the efficient frontier by using the derivative contracts as portfolio insurance. We could do it that way too. And then the last piece de resistance with the overall portfolio strategy was when the principal passed away and the death benefit went into the estate, and the beneficiaries were able to move up onto a higher utility curve, which is where everybody wanted at the very beginning. Higher utility, higher return, lower relative risk. That's what they wanted, and that's how they got it. Derivative trades. We learned how to trade derivatives if you were forecasting prices to go up, prices to go down, using indices, forwards, futures, options on futures, ETFs and stocks, buy on margin, sell short, buy right, puts and calls, depending on what the position is. We looked at technical stock analysis or technical securities analysis. We identified resistance lines and support lines and trend lines and breakouts and accumulation, consolidation, sideways patterns to be able to basically use technical analysis in conjunction with your fundamental analysis to be able to predict where stock prices are going to go, either up or down. Doesn't matter. We can make money, we can hedge in either direction depending on who the client is. We also calculated intrinsic values and applied those theories such as perpetuity, Gordon growth, multiple approach, and DCF. We also did problems calculating ROE, using the DuPont model, investment decision-making, capital budgeting decision-making. On the midterm, we basically applied these investment decision-making. We looked at case studies coming from a venture capital or private equity standpoint, looking at either newly established or startup companies in the acquisition with a focus on the multiple approach for that case study, because that's how we value these firms. The DCF and the Gordon growth and the perpetuity don't work very well. Then we looked at an established tech firm where the valuation was more focused on the DCF model because DCF is more applicable to established firms. We looked at an established tech stock. We looked at a publicly traded real estate investment trust. We looked at a commercial real estate development, i.e. Salesforce Tower in downtown San Francisco. We looked at a mixed use project of commercial, residential, retail, medical, biomedical, and a research university, which was basically Mission Bay, anchored by UCSF. So we walked through that process. And then lastly, on the midterm application in theory and investment decision making, we went through 4 iterations. The first was, is the project net present value positive? If it isn't, if it's negative, then you ask for a price reduction in the amount of the negative net present value. And then the third iteration, if you still get a negative net present value, is you gotta look at all your assumption and re-underwrite the project. And then the fourth is if you still get a negative net present value, you have to calculate the value of the real call option. And if the value of the real call option is equal to the negative NPV, then your net present value is 0. Or if it's greater than the negative NPV, then your net present value is positive and you accept the project. And we know that the valuation of the real call options are driven by management decisions, time, and volatility. On the final is just a continuation of the applications in investment decision making. Lastly, what you did over the last couple of weeks is you applied a lot of the skills that you had learned in class and actually applied them to produce an actual graduate level, corporate level product if you took it seriously. What we did was we applied the evaluation methods and we came up with a recommendation or recommendations, trade recommendations, and then we presented the presentation in business attire, and then we produced a professionally bound, professionally produced deck or pitch book. If you still haven't produced that yet, I will take a look at it, but if I look at it and I find a lot of errors, I'm probably just gonna throw it out, okay, because I can't use it. And then the leaders of the teams, what you should do is write a little note and stick it in the middle of the presentation, telling me the performance of the people that you worked with and how did they do and where did they perform, did they work with you, was it collaborative, or did the person just not show up and exit and don't do anything? I get that sometimes too. And then lastly, resume. I had you, if you took it seriously, you basically submitted your resumes throughout the semester. You met with me about your resumes. We cleaned up your resume. Mary Beth worked on your resume. I gave you some internship and some job referrals and basically pointed you in the direction of Mary Beth and some other opportunities to get you started, because they're going to be looking at the number of internships that you've done since you've been here. And if you have 3, you're in. If you have 2, you're probably in. If you have 1, that's good. If you have none, you have a challenge. Okay? These are just the standards that they're looking at when they evaluate you, because you're going to be competing against Cal, Stanford, Cal Poly, Davis, a lot of these other schools too. Okay? And we can compete at the Ivy League if you can compete at the Ivy League. If you believe you can compete at the Ivy League and you take it seriously, you can compete at the Ivy League level. Okay? The question is, do you believe it? We also went through the book, and you did most of the presentations. I did some of the presentations with some augmentation. The book basically started out with the role of the financial manager, the financial system, the effects and determination of interest rates, financial statements and financial ratios, particularly determination of cash flows. You're going to be using net operating income in real estate, you're using EBITDA for startup companies, and you're using earnings for established companies. We analyze financial statements, a common size, looking and comparing these financial ratios to an industry and a peer group and a direct competitor, which was then applied. We looked at time value of money, we looked at discounted cash flow and the valuation process, risk return, bond valuation, term structure, interest rates, stock valuation, capital budgeting, cash flows, project economics, the cost of capital, weighted average cost of capital, and CAPM, the 2 main methods. You're going to get asked these questions in an interview. somebody came to me the other day, said, Professor Suze, was totally prepared for the interview that I had. They asked me how I calculated the standard deviation, what CAPM was. It was easy. Working capital management, we talked a little bit about that. New venture capital finance, we talked a little bit about that. Capital structure to minimize the weighted average cost of capital. How are we using, or what's the capital structure, the capital stack of the liabilities to finance the assets? If I can minimize my WACC and I can maximize my internal rate of return on my assets, I can maximize the spread or the economic value add or the market value add. Unfortunately, we don't talk much about that because we don't have an intermediate financial management course, and that was really not discussed in the book. We talked about dividends and stock repurchases and payout strategies. We talked about business structuring, C Corps, S Corps, sole proprietorships, I don't recommend, LLCs, which a lot of people form around their companies, growth in cash flows, valuation, financial planning, which I'll talk about financial planning today on a personal level, give you some intellectual infrastructure that I believe you need before you leave here. Nobody teaches you any financial planning whatsoever, which is criminal. We basically just send you out into the world with really no tools. We give you corporate finance, but that's not personal financial planning. Options theory, we right off the bat started in options theory because it's one of the most difficult concepts to take away from the class. We started at day one and applied the options and the derivatives and the futures and forwards right into the memos right off the bat, so that by the time you got here, you had a good understanding of the derivatives contracts and you knew how to apply them. And then we talked a little bit about international financial management. What were the channels of communication that I used to try to engage you on a personal level and to constantly communicate with you on an ongoing basis so that there was no miscommunication within the class? I used the course website as the portal for all the resources and the content. I updated and videotaped every single lecture and posted, which took me a long time to basically post a lot of those videos so that you had a chronology that basically chronicled and tracked all of the knowledge within the class over the semester so that you could go back and review some of the core concepts for learning and relearning and reinforcement so that when you walked into any of the exams, you had the opportunity to basically excel on the exam. I also provided you with exam review sessions if you took advantage of them to also boost your grade and help you in that way. I also allowed you to provide me with deliverable packages and then go back and rework the deliverable packages to basically correct a lot of the work that you may have missed. And then for those of you that still were challenged, I sat down with you individually and walked you through the key course concepts so that at least you would have that tool and that understanding when you left my class, instead of just penalizing you for not knowing it or not remembering it. I want you to know it and I want you to remember it. I talked to a lot of people on the phone. I communicated with people via email. I communicated with people via text. I thought I was very responsive via emails and particularly texts and even phones. I responded to you pretty much in less than 20 minutes and definitely less than 24 hours in most cases. And then I provided myself and made myself extremely available a lot and gave you all of my office hours so that you could come see me to make sure that you were on track, that you were doing well, that there was, if anything needed to be remediated, it could be remediated, and that I was showing you that I basically care about you and your success. And there was probably some other things that I did or didn't do, but that was basically, I think, the goals, objectives, and the strategy that I hope you took away from the class. Okay. Any questions or comments? This is a great opportunity. You're going to be sitting in a room with a bunch of people, and you're going to make a presentation, or people are going to be discussing stuff. These are great opportunities for questions and comments on how to improve the class, what was good about it. You need to engage. You really need to engage and take this opportunity to give me some critical feedback or some pointers or what worked, what didn't work, because I'm constantly trying to make the class better. when you get into the real world, you're not gonna get paid for silence. You're not. And it's easy to let other people speak up. I'm just giving you some advice. It's easy to let other people speak up.
I feel like at least for the beginning of the class, I know you mentioned that you wanted to start things off pretty fast. And then
You do
slow
what?
them. I know you mentioned you wanted to start things off fast and then slow things down.
Yep.
As, you know, we got more tired towards the end of the
That's right.
semester. I feel like in the beginning still, I was hit with a lot of terms I didn't quite understand initially, and it was kind of hard to follow along from there.
Sure.
So maybe spend a little bit more time on what a commodity is or what a security is, because sometimes, you know, I feel like some people might not know what that is coming in, and that could drastically affect your education if you're, you know, if the word security is being repeated and then you're like, what's security exactly?
I really appreciate that, and that's been critical feedback that I've gotten over the years. One of my responses is, you know, reading the book really helps out too. And the assumption is that you're reading the book. And I've been told a lot of students don't read the book and they actually try to go through courses without reading the book. So, you know, I'll take it both ways. Thank you.
I like the repetitive structure of the course. I liked how it wasn't necessarily the fact that we come in and take tests. It's we do the test, we learn it, and then we repeat, so it helps us understand that. It helped me writing down everything twice. Helped me remember terms and how to do the DCF and all the equations.
Yeah, it took me years. It took me years to go through these concepts over and over and over again. And one day it was like, oh, you know, I got it. Years later, I get it. And then, you know, went on, did a master's in finance, did doctoral work in finance. You're constantly learning, reinforcing. You're going to forget it. You're not going to get it. You got to constantly be reinforcing this stuff if you want to learn it. My recommendation is you really should learn it because you're going to be in a meeting, okay? And they're going to expect that you know it because you went through a business program. Okay? And if you can't engage in the conversations, then you're just eliminating yourself from a promotional opportunity if you can engage. Any other comments? I'm sure everybody's got an opinion.
I like that you let us correct our tests after we took it to get a better grade. Not a lot of professors do that.
No, it's, my view is it's like, okay, I grade you, and then we move on. You never learned it. You know, so that doesn't make sense to me. You just learn it. You know, you go back, you correct it, you learn it, you still have confusions, come see me, I'll walk you through it, and then you learn it. So I kind of like that too. It took me a long time to develop that. Yes,
Yeah, I'll say that at the beginning, like I had a lot of friends that were asking me about finance professors for the next semester, and I wasn't sure about recommending you, but when as it got going, I was like, definitely take him, because like I'm actually learning this stuff, and I didn't think I would. I honestly listened to you at the beginning of the first day, and I was like, one, overwhelmed, and two, thought I would fail for sure. Like I was like, there's no way I would.
That's the real world. Okay, I teach this more as a laboratory, and I create that cognitive dissonance between the students to try to get them to stretch, because working in the real world is extremely uncomfortable, and people are going to walk in, they're going to start talking tech talk or marketing talk or finance talk or accounting talk, and you're going to be completely blown out. And what you're going to need to do is you're going to have to learn really quickly. You're going to have to learn really. So I try to create that stress and that cognitive dissonance to get you to say, oh, you know, I need to, maybe I should learn this stuff. And then what happens too is it weeds out some of the students that are completely overwhelmed and don't have the self-efficacy and the self-confidence to stick with it. Because I can't manage that tail end of the curve. It's too emotional for me. But if I can set some kind of standard that, I don't say weeds them out, but maybe I'm just not the type of professor for them, they can go find somebody else that's more, that creates a class environment that's probably more applicable for them. And I try to teach it as a lab, okay, with real world outcomes in a laboratory. Anybody else?
the idea of creating something. I feel like the memo is in the deck. It's something that we make ourselves and we own it. And some of the other classes you don't really do that. So I like the idea of creating something that's yours. And then you
Yeah,
actually
the deliverable is that creation, it's that product creation. I look at these deliverables and I'm just blown away. You know, the quality of the work, the organization. You know, I show them to the dean, to the associate dean, to, you know, some of the other professors I'll show that are looking for some ideas, but it's a lot of work. You know, you put a lot of work into it. You know, I put a lot of work into grading it and giving you feedback, and I think the outcomes are a lot higher. Because usually I can get like 95% of the course can get an A. You know, it's the other people that are doing other stuff, or, you know, they have some issues or something that I have to spend a little bit more time with to get them into that area. And some people they just want to see, they don't want to work that hard. So I kind of deal with that. But I can get really high outcomes, I think, through this methodology, if you agree. Yes.
Similar thing, like we get to take our resumes away as well. I think it's a similar thing to the memos. And I think that a resume is really important to come out of college with. I think just understanding what businesses are looking for is something that you can't comprehend by yourself.
Yeah, and luckily you have me and Mary Beth. She's really great, but the one thing that I invented maybe 3-4 years ago was actually sitting down and interviewing the students and pulling out some of the production metrics from what they produced, either revenue or gross receipts or number of clients or calls or whatever, and putting those into those jobs and bolding them. And when the people look at those and they see these metrics, nobody else does it. So you stand out just like that, and they love it. So that sometimes it's just that marginal improvement that will get you the job or get you the interview or the internship. Thanks.
I was going to add on to that. I think this is probably one of the few classes I've taken at St. Mary's where you actually do something that builds up your career choices and abilities to get jobs in the real world. Like, frankly, most of the rest of the education at St. Mary's is just formal. You don't really actually learn that much. You get out in the working world and learn it, but it's like, I've taken this class and I took investments as well. And actually having the legitimate portfolio that you can show in an interview or show at the time of a promotion can seriously make a difference. So like, I don't know if you guys know Riley Jackson, but I do. He helped get his own job because he had like the financial investments background where he had like the full portfolio to show him. So you actually get stuff that you can really use. So hang on to it.
Yeah, and I'm willing to work with all of you, you know, on a one-on-one, you know, references, referrals, you know, coaching, you know, any of that stuff, because that's where I came from. I didn't come from the academic realm, you know, and move my way up this way. I came from industry and moved up. I was doing academics simultaneous through the whole 25-year career. So it's a different approach, and I wanted to bring that here, and that was one of the reasons why they brought me here. Any other comments? Yes.
I like that you posted all the lectures, because I thought they actually wrote to me about like most of them doing the project and the final. I think that was really helpful.
Yeah, and I try to get those up as soon as possible too. Okay, anything else? Yeah, Jake?
Quick question. Why don't more classes at St. Mary's do these type of projects to where you can actually take them into the working world? Like,
because a lot of the professors don't come from the real world. They come from academia. So, and some do, some don't. But I guess it's an academic methodology, epistemology, philosophy that what I'm hearing does not prepare students. Employers now are saying, you know, students are going through their education. They're not learning how to produce product, think critically, work in teams, work on projects, and produce. They're not doing that. So when they get out, we got to train them to do that. And by that time, it's really too late. So it's just where I came from. You know, managing teams and managing divisions, managing departments. I don't look at you as students. I look at you as colleagues. You know, that I want to work with. I want to develop. I want to produce together. I don't want to be the professor, you know, subjecting you to requirements and then, arbitrarily assigning some kind of diagnostic based on that instrument. No, it's gotta be interactive, it's gotta be one-on-one, it's gotta be project-based, team-based, and it's gotta be production quality-based. So you're totally prepared by the time you get out. And I don't know why they don't. You have to ask them. Okay, anybody else? Okay. So what I want to do, how much time do we have left? An hour?
Over an hour.
Hour?
An hour and 10.
Hour 10? So what I'm gonna do is the exit lecture, and then we'll watch the movie whatever time we have left. Yeah, you're probably asking, what the hell is this? Why is Professor Susan putting this garbage, up on the whiteboard? It looks like graffiti. Basically is what it is, what I have here on the board, which I'll spend the next 40 minutes going through, and you're gonna have to time me, because I do kind of talk too much. What it is, I was asked about 8 years ago by one of my friends. She had become the president of commercial real estate living in San Francisco, which I sat on the board for 2 years and then participated in the organization for over 8. She came to me, she said, Larry, I've been selected to be the president of the organization. I need a coach, I need somebody to work with me. I was wondering if you would work with me. Now, I'd never worked with anybody of that stature or that age or that caliber before. It was mostly students or people within 3 to 5 years out of college. That's kind of my target demographic. But I said, okay, I'll do it, but you gotta give me 2 weeks, because I've built some models over the years, but I haven't really pulled them all together into a formal program. Give me a couple weeks, I'll pull it together, and then I'll come back and I'll do the presentation to you, and then I'll work with you on a one-on-one. The presentation is a one-shot deal, okay? It's one shot, it's 40 minutes, maybe 50, and then you go off, and what I would do is take notes on it. It's basically your strategic business plan for your life. And then what you should do, and what I was making my other students do, was to update this. The people who were actually into this program, was I said, you need to go back and rewrite the notes 2 days from now, 2 weeks from now, every 2 years. So you're constantly updating your business strategy and your own personal plan, okay? It's a 9-module system, okay? And I'm gonna walk you through it. It takes about 40 minutes. I go really quick, no questions during, and will you follow me through my presentation? Thank you. No questions, please, because I really need to kind of focus on this. And then at the end, if you have any questions, I'll take any questions. You've seen some of this material, but you haven't seen it integrated into a formal presentation that's continuous. Okay, so the first model, and I need everybody to turn off their computers. I need you to put your phones away. I need all that stuff turned off. You're going to need to close your computers and put your phones away. You have to close your computers. Put your phones away. And I need you to focus, too, so that you can gain the whole experience. And you're going to need to turn off your computers. Can you turn off your screens, because those are just distracting. Okay, we're going to start over here. The first thing we're going to start off with is what I call the nomenclature of knowledge. And basically, we're all lucky because we're in the business school. We're in the social science department. We're not in the sciences. They're very focused and very narrow. We're in basically a broad multidisciplinary degree. We learned a lot about everything: psychology, anthropology, technical aspects, finance, organizational theory, sociology, psychology, all of those things all pulled together within a degree. That's why the business degree is so valuable. What I've come up with is a system. I've come to the conclusion, or my conclusion when I designed this in, what was this, 1996, I developed this model and then presented it to my classes ever since. What I realized is you have to know a little bit about everything, and you gotta know a lot about the areas that you focus on. When you're building models, and this is an intellectual model, this is basically an operating system for your brain. You gotta know a little bit, and probably a lot, about certain institutions of thought and institutions of knowledge. You have to understand the accounting, both managerial and financial. You have to understand the finance, and finance also bleeds into the capital markets, which is also affected by monetary and fiscal policy, so you have to understand the economics. You gotta understand public administration and political science and law, because the law is basically debated and battled out in the political context here in the United States, and from those political and policy outcomes, those policies become law, and then they're administered through the bureaucracy. So each one of those levels will have an effect on policy and policy outcomes. And policy outcomes are both intended and unintended. Tax policies, monetary policy, every time the government and government institutions implement policy, there's going to be intended and unintended consequences associated with those policy outcomes. And if you're in the way of positive policy outcomes, the positive externalities, you take advantage of it and you leverage. If you are in the path of negative externalities associated with those policy outcomes, both direct and indirect, you better do something about it. Because if you don't, you're going to be negatively impacted. Either wealth, you may lose your job, you may have your house condemned, you may have your house through eminent domain taken, so you have to do something about it. You have to have contingency plans in place. You have to also understand theology and psychology and sociology, which is why you're going to a liberal institution. Theology, if you look at theology, basically our society and our commerce, our system, is basically a derivative of theological systems that have been handed down over the 5,000 to 6,000 years. If you look at theological societies dating back 5,000 years, and you look at our society, the organizational structures have not really changed that much. We're just in a democratic, capitalistic society here, where in theological systems you have the same organizational structures of power that were basically in place. So what you do is you need to understand all of these institutions of knowledge, and actually these institutions of knowledge are actually regression equations with variables in them. And each equation has 50 variables. So you have 11 equations and 50 variables. That's 11 times 50 factorial. It's impossible to data collect all of this and data process it. When I developed this in 1996, we didn't have the technology. You have the technology now to be basically be able to collect the data, build the models, solve the valuation equation of the equity, your stock equity, your bonds, valuations, your real estate equity. You can now program this, store the data and collect the data, process the data in the cloud, and to be able to get these outcomes and know the direction of the value of your equity, either up or down, either instantaneously, continuously, or in the future. But it wasn't until recently that we had the technology. The individual brain is the most powerful supercomputer. The biological engineering around the human brain, we transact 1 trillion transactions per day biologically within our brain. Therefore, our brain is the most powerful supercomputer ever engineered. We have infinite storage, infinite processing capabilities. We can basically understand this model, implant it in our brain as an operating system, collect the data, retrieve the data, create the information, make decisive decisions very quickly, and move forward knowing that the decisions that we made were correct based on the knowledge and the information that we put into our brain. We are the most powerful supercomputer. You have the most powerful supercomputer sitting on top of your brain right now. And now with your brain basically enabled, who's got a cell phone, with the most powerful supercomputer, let me see your cell phone, you are now enabled. With this supercomputer right here, this is a supercomputer. There used to be rooms and rooms and rooms of processing and storage that would take up the same capabilities as a phone that you have in your pocket now. You can now are totally enabled, totally networked, total communications. You can do anything and almost everything on your phone. You are the enabling force now with the power of this technology in your hand. The question will be, how do you use the power and the technology? Is it going to be for good? Is it going to be for evil? Because once you understand your power, you have to make ethical and moral decisions. Okay? And you will be confronted with those ethical and moral decisions. This system actually works here in the United States, and particularly here at St. Mary's and in the Bay Area, because we live in an environment of peace. Okay? We are not in Mosul. We are not in Baghdad. We are not in some of the worst places in the world where there are no institutions. There is no capability of knowledge there. The physical structures and the architectures and the urban landscapes there and the culture itself is utterly and totally destroyed. You cannot gain knowledge or intellect in an environment like that. So we are extremely, extremely lucky to be doing what we're doing today. And the reason why we can do this model is we have standardized linguistics. Everybody pretty much on a global basis who's in a certain elite class speaks English. We all pretty much use the same language. We all pretty much have the same cultures, although they're slightly differentiated. We all communicate. Now we can communicate technologically through telecommunications and technology. And if you look at the most major metropolitan areas in the world, the architecture and the architects are basically the same. They're all beautiful. So the reflection of your culture is basically in the urban landscape and your architecture at the end of the day. So the major takeaway from this is it's machine language. You know, it's big data applications. It's how the world basically works in a social scientific context. It's extremely complex. It's based on institutions of knowledge. It's basically a simultaneous regression equation that can now be solved with technology today. It's multi-institutional. It's multiple regression and biological processing and infinite storage is basically the comparative advantage that you have over machines. And I hope we were able to keep that comparative advantage going forward. The second model is you're going to be talking to a lot of people. You're going to be networking. Talking to people, and the first thing you need to do is to sum up the individual within 2 seconds and know where the individual is within the organizational structure and within the social class, so that you can modify your language and your behavior to basically target that individual so that you can communicate at the exact same level. If somebody has to come down to talk to you, they're going to have to work, okay? You're going to have to come up to their level and work to be able to communicate, but you got to identify the psychology very quickly. They're probably going to give you a business card, and they're going to introduce themselves for you. Right then and there, you're going to know where within the organizational structure do they lie. Are they in the organic, team-based project program management area? Are they mid-level managers or EVPs or executive vice presidents? Are you talking to the CEO or the president of the company or the board of directors or the chairman of the board? You better modify your language and how you communicate with them depending on the person that you're talking to. Once you've modified the language and come up with a strategy, then you can start to use that information to navigate, not only within the organization, but get into the organization. Once you've understood them and you get into the organization, you have to understand where you are within the organization and start plotting your mobility. And if you want upward mobility within the organization, you're going to have to start plotting and planning what I need to do to get where I want to go within the time period that I've basically laid out. And you're usually going to start down here in the organic team-based area, and some people love to stay there because they love to work in teams, project teams, cross-sectional teams, product teams, cross-functional teams, and they like to stay at this level. Some people like to move up, into the associate or the managerial level. Then you want to get into the executive vice president or the managing director level where you're overseeing your own division. But to get to the CEO, COO, CFO, maybe the president level, you got to navigate, and you may have to actually go lateral at some point to go vertical, or you might have to go outside the organization because you run into bottlenecks or glass ceilings based on race or gender or social class. And you can't be stopped. Once you run into a certain glass ceiling or a bottleneck, you gotta keep moving, and if they're not willing to give you the opportunity to move, you gotta move and you gotta go outside the company to basically arbitrage your human capital that you've built up within the organization. This process to get up here takes a lot of work, okay? It takes a lot of work, and you gotta be willing to sacrifice to make it happen, if you're willing to make it happen. So the major takeaways from this is you have to be able to scan the organizational structure. You gotta understand the organizational design of the company based on industry, based on size of the company, based on the product lines. So you gotta understand and apply everything that you've learned within your courses. You are gonna use everything that you've learned in all of your classes, both in the first 2 years and the last 2 years. So you need to get out of your head, for some of you, that I'm not gonna learn, I'm not gonna need this stuff at some point in the future. You are. And you're gonna be called upon it, and you're gonna go, boom, I had that in my quantitative analysis class, or my management class, or my marketing class, or my finance. I remember that, so I can apply it. Okay? You need to determine your location, and you need to determine the value that you create and that you're adding within the division, within the position, within the company, and you need to be able to articulate that so that you can leverage it. You need to understand how to navigate, to arbitrage your human capital, and how to build and accumulate human capital. When you walk in and you start working in a position, you are now accumulating and building human equity and human capital that then you can leverage either within the company or outside the company. You need to be willing to move, and you need to be willing to execute. If you get stuck, you gotta move. The company's myopic, you got a bad manager, the company is making bad decisions, maybe illegal decisions, you gotta get out, you gotta move. Somebody gives you a better opportunity to go somewhere else, you weigh the costs and the benefits, and if it looks like it's a better place to go, go. Don't wait, okay, you're wasting your time, okay, you're wasting time. You gotta be able to communicate vertically and horizontally within the organization. You gotta be able to communicate with other people, across functions, across product lines. You gotta be able to communicate with people at senior level, mid-level, lower level management. You gotta be able to adapt very quickly and basically obtain the linguistics that you need to communicate with these people precisely and extremely effectively, okay? Because they don't have time. They will get impatient. And you gotta be ready to go at all times. Be ready to go. Get your resume, get your references, get everything ready to go, get ready to go. Always be ready to go. Have your references in place. Have your professor references, have your business references. Have your portfolios in place. Have your resume, be ready to go. And don't forget to network and get out there and ask for business cards, get business cards. Go meet with people, go talk to people. And the more people you talk to, the more people you meet, the more relationships you build, the better off you're gonna be, because your net worth at some point in time is gonna be your network, is your net worth, okay? Thirdly, you have to have a plan, okay? You gotta have a 20, 30-year plan. 20, 30, 40 years goes like that. If you don't have a plan, you're reacting to everything. You're not planning strategically or tactically. And then you're not using the operational opportunities to you to achieve those tactical goals and your ultimate strategic objectives. So you have to think strategically. So here's basically the 30, 40-year plan laid out. Well, first, to get to the C position, if that's where you want to go, you have to ask yourself, what am I willing to sacrifice and what am I not willing to sacrifice? And that's basically going to set out basically your ability and capabilities to get to where you want to go. You got to ask yourself, am I willing to sacrifice relationships, sacrifice times with my family? Am I willing to sacrifice my music, my sports? Am I not willing to sacrifice my family, my sports, my music? Whatever it is that's important to you, you have to figure out what you're willing to sacrifice and what you're not willing to sacrifice, because time is your enemy and time is your friend, okay? So that's the first thing that needs to be done. You need to evaluate your priorities and what you're willing to sacrifice and what you're not willing to sacrifice. Secondly, your bachelor's degree is just a ticket into the baseball game. I'm going to use a sports analogy. is a ticket into the baseball game. The goal is not to get into the baseball game. The goal is to get on the field and become a player, a professional player. But the ticket to get in is just your bachelor's degree. That should get you in. Then once you get the bachelor's degree, which could take 4 to 7 years depending on who you are and where you're going, you're in this 5 to 7 year intermediate period, almost an apprentice period, a bardo state before you get into moving up into higher levels of responsibility. In these 5 to 7 years, depending on who you are, if you're an accountant, you need to take down the CPA and get your CPA license. If you're in finance, you got to get the CFA exam within 3 years. If you're in wealth management, you got to get the Series 7, 66, insurance, long-term care. If you're in project or product management, you got to get the PMP designation. If you're in product or software development, you probably got to get a Microsoft or an R or Python or some other types of certifications and licenses to be basically build on your core skill sets. If you're shooting for the Ivy League, which I highly recommend, you got to be thinking about that at least 2 years in advance because you got to ace the GMAT, which is the #1 instrument that they're looking at. You got to be in the upper 90th percentile. You got to have at least a 3.6. You have to have really good work experience, and you got to have good letters of recommendation and a solid statement of purpose if that's what you're shooting for. That would be like a level 1, tier 1, Wharton, Stanford, those things. If you want tier 2, that would be like Davis, UC, and tier 3, 4 would be like Golden Gate and other universities. But you got to be planning, and it's not even 2 years, okay? Because you only go basically 4 semesters, and you have the summer off to go work on Wall Street or go work in a tech company to basically get the experience. And by the time you're done with the internship, 9 times out of 10, they've already offered you a job, and you might have actually even negotiated, or they may have offered to pay for the rest of your education and to back pay the loans that you paid off. And if they give you bonuses, you can use the bonuses to pay back your student loans. So it's not about the money and the inability to afford the education, it's are you focused and is that something you want to do and can you get in? That's the focus. It's not the money. You can pull the money together through savings or your parents or loans or grants or the employer. You can get it paid. The question is, can you get in? And if that's what you want to do, shoot for the best school because they recruit from the best school. The best companies recruit from the best schools, and they recruit from the schools that they went to school at. So once you get done with the 2-year program, and now you can do executive programs that are awesome. You can go to Wharton or Cal, do a 2-year program with 7 years of experience, which is awesome. So you can go to a top Ivy League and not even stop working if that's something that you want. But once you graduate, you get into an associate apprentice program underneath a managing director or an executive vice president. Now these people are highly mobile too. They're extremely motivated, and they want to move up to take over the C position or move out to take a C position. So if you move in as an associate apprentice under a highly qualified executive managing director and vice president, when they leave, you move up. You move up. So it's extremely strategic doing it that way too. And then you have to get to the CEO position. If that's what you want, you got to be willing to sacrifice a lot to get there. So if you look at it, 4 to 7 years for the bachelor's, 3, maybe 5 to 7 years in this pre-grad school level, 2 years if you decide to do that. Apprentice program, associate 3 to 5 years, EVP 10 years, and then 10 to 20 years at the CEO, CFO, CIO level. So if you look at it, if this is something that you want to do, it's going to take you probably, 15, 20 years to get there. And you're going to be extremely rich if you do it. Because you'll be wielding a lot of power. Now here's the sad part, and I'm going to deviate a little bit here. Here's the sad part of the equation. If these are your aspirations to go to this level and be at this professional level, and you think that you can make, on average, $100,000 a year over a 30 to 40 year period, $100,000 a year is totally doable over a 30 to 40 year period. Basically, the income that you would generate over that 30 to 40 year period is $3 to $4 million. So basically, if this is your aspiration, you currently sitting in that chair you guys are worth $3 to $4 million bucks. $3 to $4 million bucks. So what happens if something happens to you? Hit by a car accident, diabetes, Crohn's disease, some kind of genetic, it happens. I've had students that haven't made it, okay? And what happens is they end up passing away and their parents get nothing. The parents ended up spending $250,000 to $500,000 bucks sending their kids through school from 12K through college, and they got nothing because the kids, you, didn't believe in life insurance. Didn't buy $1 million or a $2 million life insurance policy for $400 to $500 bucks a year for 30 years. 400 bucks, that's beer money, that you could buy, pay premium per year for 30 years, and if something happens to you, your parents are well off, your family is taken care of. For some of you, it's gonna happen. So get your life insurance, do something for your family. If something happens to you, they'll be taken care of. If you don't, you're just gonna be leaving them with a liability, okay? Because they're investing everything in you with the anticipation that you're gonna be the asset that's gonna pay a perpetuity that's gonna take care of them in the future. Ask them, talk to them, and they will tell you, yes, we invested everything in you, and we know that you're gonna go on and be successful, and you're gonna help us out in the future if we need it. But if you're not around, you can't help them. So this is one of the biggest problems with young adults. They don't believe in this stuff. Because they tell me they don't have kids and they're not married. Doesn't matter, take care of your family. So 20 to 30 years goes past. You got a plan and you got to stay on track. If that's what you want to do, you got a plan and you got to stay on track. You got to shoot for the best school and the best program. The other is don't let anybody get in your way. I pursued this and I pursued all this stuff, and I had people getting in my way telling me, I don't understand why you're doing that. I would never do that. Don't do that. I would never do that. Why are you doing that? You can't explain this stuff to people in 2 seconds or 2 minutes or even 2 hours because you have your own vision, your own passion. In a lot of cases, they don't really even care, most of the people. They're just projecting onto you their dreams and aspirations, their frustrations. They're projecting onto you their negative psychology, and they're just getting in your way. Get them out of the way. Tell them what they want to hear, or tell them to get the hell out of the way and get them go around it and move on. Because you can't have people in your way obstructing you. You can't. It's too costly. If they make you make a mistake, you can't go back in time. You can't correct the mistake. You got to live your own passion. So go through them, go around them, always go forward. The next model. This is the fourth model. The fourth model is a social learning model. Social learning theory was invented or written by Albert Bandura based on B.F. Skinner's work in conditional response and human behavior, conditioned human behavior. And Bandura wrote books on social learning and self-efficacy, and basically I've remodeled his model to basically use it for career coaching. And basically Bandura says is that we all have, and particularly you in general, you have this ideal self. You are here working towards this self in which you want to become. You're not there yet. So there's an ideal or a target self that you're trying to shoot towards and work towards. The problem is you're here. Your actual self is here. Your ideal and your target self is here. The question is, how do you get from here to here, and how do you close this cognitive dissonance, the cognitive dissonance gap between where you are and where you want to be? The way that you do it is you use the process of self-efficacy. Self-efficacy. I want to get there. I don't really know how to do it. I've seen other people be successful. I'm going to target and model other models that have these attributes that I want to emulate because I've seen them be successful. I want to be successful. Therefore, I'm going to emulate their attributes, them as models, and I'm going to try to close this cognitive dissonance so that I can get to my ideal or my target self. Now, the problem is I get a lot of people, particularly students, that say, well, I'm a creative managerial type. I really like working with people. Not very good at the quantitative stuff or the financial analysis. I don't want to do that. I'm not going to learn that. I don't like it because I've seen people become successful over here in management and sales. I'm really good at management and sales. I'm gonna go down the path of management and sales. My parents, my uncle, my sister, my brother were good salespeople. I'm good at it too because I have a genetic predisposition to sales. Therefore, I'm gonna go down that path and that's gonna be my success. Then I see people on the other side, the math and science people, that basically say, I don't wanna work with people. I just wanna be an analyst. I don't wanna do any sales. I don't wanna do the marketing stuff. I'm good at basically math and modeling and analysis. My dad, my mom, my sister, my brother, my uncle were all analysts. They became extremely successful. I don't like doing the people stuff or the management stuff. I'm going to stay over here on the scientific and the analytical side, and I've seen people successful. I'm going to stay on that side. That's not the case. Actually, the students from the top schools and these people that make it up here are good at both. Okay, they didn't have a genetic predisposition to any one of the two areas. Maybe they did, maybe they didn't, but they realized where their weaknesses were and that they wanted to build on their weaknesses so that they could be strong in the people skills and in the managerial skills, but also be good at the quant skills and the analytical skills. So they became a hybrid individual that basically understood their weaknesses and went out and basically corrected their weaknesses by doing stuff they didn't want to do. They failed a lot of times within the process of trying to do these things, but here was the key. They didn't look at failure as a genetic predisposition. They looked at failure as a lack of information and maybe a lack of persistence in trying. So they got back up, they did it again until they got it, until they got the 90th percentile on the GMAT, until they reached the EVP or the CEO position. They just kept going. And they didn't look at it as a genetic predisposition. It was just lack of information and lack of perseverance and persistence. So, self-efficacy, failure is not the genetic predisposition. It is from a lack of information and persistence. And here are the outcomes. You take this model into consideration and actually execute on it, there are actual outcomes that will come from it. And the outcomes that come from it is, one, you will then create a persona, an individual personality. The personality that you have when you walk into a room, you will command presence within that room. First thing they look at is going to be your dress. The second thing they're going to listen to is your communication skills and how do you communicate and at what level and how precisely you can communicate. Do you have the charisma to basically be a leader, to get people to follow you, to get them to do what you need them to do without coercion? You can pay people a lot of money. That's not going to motivate people up to a certain point. They want to work with people they like. They want to work with people they admire. They want to work with people they want to model. Then if you can do that, you're going to obtain power and the power of persuasion to then get people to do things. Okay? And you're going to have to get people to do things if you're going to be in a management position. And the most important takeaway from all of this is that you will then become a model for other individuals. You will then become a model for other individuals, and people will come to you and say, Larry, take me with you. Hire me. Tell me. Work with me. Tell me how to do these things. Can you help me? And then you have to decide, this is the best part about it, and this is the worst part about it, is you will have to decide if you want to take that person with you. And you will take the people you want to take with you that you want, and you will have to leave the others behind, either because of character flaws or different types of behavioral characteristics, maybe criminality or pathologies or psychoses that you've observed from those individuals, and you will have to decide if you're going to take them with you or not. That's where the power comes in. How am I doing on time? Pretty good. So to be able to achieve all of this stuff, you got to be extremely organized. Extremely organized. Larry, how did you teach all the time? How did you do 5 master's degree and a doctorate? How did you work full time for all of those years? I was totally organized. Totally organized. I had my life completely planned out for 15 years. Okay. First thing I had to do was put together a strategic plan with basically my high-level objectives laid out over a 5-year period and basically ranked from high to low. And then update the 5-year plan every single year. And if something came up, my family or work came up, that I had to push down the priority or push out the priority. I really didn't care because I knew I was going to achieve the objectives anyway at some point in time. I don't care if it takes me 3 months, 3 years, or 30 years to hit that objective. The only thing that matters is you do it. Because I hear it all the time, I really wish I would have done that. Well, obviously you didn't have a plan and you didn't make it a priority. Secondly, you have to have tactical plans that basically lay out the next 3 years, either in 6-month increments or do it on a quarterly basis. I like to use the academic calendar because it lays things out really nicely. Okay? Again, you rank your goals and objectives from high to low. This is more operational, also tactical, this is strategic. I want to be in an MBA program in 3 years. I got to start my GMAT here. So you just lay the whole thing out. The operational planning also, you lay out your calendar, you start marking the major milestone dates, you back into the major milestone dates by basically hacking out time that you need to sacrifice to prepare for those milestone dates. It's either work, academics, college prep, whatever it is. And then the last is your weekly plan. This is the most important. I have my 2 weeks completely booked 2 weeks in advance on a rolling basis. Every single minute of the day, I know exactly what I'm going to be doing. And I'm booking appointments, and I'm booking phone calls, I'm meeting with students. I know exactly what I'm doing pretty much the whole time. And I can rearrange it too. I can find the gaps, you know, in the schedule to be able to plug people in. But I know what periods of time I need to block out to be able to meet my goals and objectives and to be able to meet my milestone dates. And tell people I can't meet with you now. I can meet with you here, but I can't meet with you here. So this is extremely critical that you have really good time management skills. You can't be reactive, you gotta be proactive, or else you're gonna be wasting time, okay? Okay, so the last two are personal financial planning. You guys are gonna be extremely successful and extremely wealthy. The wealth that's being handed down by your grandparents and your parents in most cases, and just being here at this university creates opportunities for you to be able to move forward and make the 3 to 4 million bucks. And if you invest your money correctly and you don't lose your money, you'll probably end up with $4 to $8 million in accumulated wealth at some point in time, and you'll be able to retire early. And if you don't stick to the program, it's not going to happen. Okay. So the first thing is investments. How do you invest? Well, the first thing that's going to happen is you're going to go work for a company, and they're going to offer you a 401k. They'll either match or not match. Okay. If you're self-employed, you're going to have what is called a SEP IRA or a defined benefit program. Defined benefit's awesome because I can pump $250 grand a year into that defined benefit program per year pre-tax. It's amazing. Okay. And then you get the 401ks. And as you start moving around to different companies, don't leave your 401ks at those companies. Roll all that money over into a self-directed IRA and find a really good investment advisor that's going to manage your money. You'll be able to pull the money out of the retirement account at 59.5, penalty-free, but then the government is basically going to show up on your doorstep at 70.5 and say, we want our money. So they're going to take all your accumulated wealth that was in this pre-tax qualified account, do a formula and say, start giving me my money, and we want our taxes. Okay, so you're going to have to do that. It's called required minimum distribution. You're going to max out in this area over here because you don't want too much of your money in these qualified accounts, because when you start taking the money between 59.5 and 70.5, if you put too much money in here, you're going to be getting too much income, and it's going to throw you into a higher tax bracket, and they're going to slap on not only higher tax rates, but also alternative minimum tax. You're going to be put into a higher tax bracket. So you got to have around 25% of your net wealth in that area. And you want to invest aggressively, be in equities, because you're young, you can handle it, you'll be around 30 to 40 years. Then you're forced into the non-qualified, the after-tax realm. That's where you're going to invest in, after tax, you're going to be investing in life insurance, businesses, real estate, and there's tax advantages to that too, because you're buying these things at after-tax money, so you get depreciation, recapture, all kinds of stuff. And you can also do a Roth IRA too, where you already pay the taxes, and then when you retire, you pull the money out tax-free. That's a good one too. you should have about 50% of your money in that after-tax aggressive realm. Then what happens is the stock market booms, your real estate booms, you get a wealth effect from your stock options. You basically liquidate a portion of that money, bring the allocation back down to 50%, take that money, bam, put it in safe, after-tax, muni bonds, you're gonna be guaranteed life insurance, cash value life insurance. This is where you're building your wealth in your annuity so you never run out of money. Never run out of money. And it doesn't make sense to put any money in the safe qualified side. So what's the menu? First thing you do is you start off with risk management. You buy a ton of convertible life insurance. First thing, where can you control $1 million asset for 30 years for $400 a year? Where? In the capital markets. What instrument? What financial instrument? What contract? Can you control $1 million asset for 30 years for $400 a year? Where? It's only life insurance. So it's the most compelling financial product ever invented over the last 167 years. It was brilliant. Then you convert the term insurance into whole life insurance, permanent insurance, that builds cash value. And when you pull out the cash value, there's no tax on it. And when you pass away, the death benefit goes to your heirs, tax-free. And you can borrow on the cash value in the life insurance, tax-free. How many times did I say tax-free? 3 times. Okay. Then you can convert it all over into variable universal life, where the premium, you can put as much as you want within the range. The premium and the cash value of the life insurance and the death benefit is tracked to either the bond market or the stock market. That's a great vehicle for younger people in their 30s and 40s. Then you should be putting some money away when you're 50 and running it through your corporation is the long-term care insurance, because you can deduct the long-term care insurance premium with you and your partner pre-tax, so that when you can't do 2 of your daily functions and you go into a convalescent home, the insurance pays and starts to pay between $200 and $400 a day to basically take care of you for the rest of your life because you're completely immobilized, pretty much. But if you don't care about that, then that's okay. You better have kids or somebody else that can take care of you. Because if you can't, you're going to find yourself in a bad position, and you're probably going to blow through all of your wealth, and it's going to go basically into the convalescent home to basically keep you alive, and then you might end up going into some kind of poverty program, okay, if you run out of money. If you're going to go work for a company, they're going to get disability insurance on you, because if you get disabled, you're going to need some money to basically keep your overall costs covered, but they're going to put a lot of disability insurance on you. Because if you're a major producer or a corporate exec, they're going to need the disability insurance to basically cover your being gone. And they're going to put life insurance on you too. Because if something happens to you, it's going to be completely disruptive to the company. The value of the company or the multiple of the company is going to go down. But if they have $5 million on you, it'll give them enough money to hire another individual to replace you or to backstop some of the loss in the revenue that you were the key person that was generating a lot of the revenue. If you're going to own property, you're going to need property casualty insurance and earthquake insurance. Because if your building burns down that you own, or you have an earthquake and they rent tag it, they have to kick out all the tenants that are paying the rent, you're either going to have to replace the building yourself out of pocket, or if you don't have the tenants that are paying the rent to cover the mortgage, then you're going to default on the mortgage, the bank's going to foreclose and take your property. You're also going to need business umbrella insurance, because if you run a business, they're going to sue you. You're definitely going to get sued. They will put you in a position and you will get sued. You need the attorneys, the badass attorneys from New York or Chicago to come in, fly in, and basically take out the perpetrator and the person that's basically trying to take you out. So you need that business insurance too. Once you get this side down, and if you don't believe in the insurance side, or you get a pre-existing condition, that stuff's gone, okay? All the life insurance stuff is gone. You get it while you're healthy, okay? And if you're not healthy, or you're sick, or you get cancer or something, you can't get this done. This is off the table, okay? So your risk management plan is done. And it also is an investment program too. I don't believe in it. I got a pre-existing condition, done, gone. Now you're thrown into this realm, which is your qualified side. Roll the 401k into a self-directed IRA, mutual funds, bonds, stocks. Problem is you're naked. If the markets collapse, you don't have any floor on it. You can actually roll the stuff into a variable annuity with a guaranteed investment protection rider that basically guarantees the money that you roll in. If the market goes down, you don't lose any money. You gotta pay them a point on the assets under management, but you're basically buying a 7-year put. And you can roll over, you can increase the floor, exercise price, 3 times over a 14-year period to lock in your wealth so that you don't lose any money. That's extremely powerful. And then you can also roll money into a guaranteed future income annuity. I got $1 million, I'm 50 years old, I give it to the life insurance company, they give me $100,000 a year when I turn 70 for the rest of my life. If I live past 10 years, I've gotten all my money out. If I live 20 years, I got an extra $1 million. If I live 30 years, I got $2 million out of the insurance company. I just gave them the $1 million to use for 20 years. They guarantee that me and my wife will get $100,000 for the rest of our life. That way we don't run out of money. I can also invest in fixed annuities when I'm 90 years old because I don't care about the market, I just need enough to live on and then pass the wealth through these annuities onto my heirs at a stepped-up basis. Then you're going to max out on this side, then you're into the non-qualified side, the after-tax. You're going to invest in stock brokerage and stock accounts and securities, have your money work for you. You're going to sell the securities at the price which you bought it for, the cost basis, and you're going to pay the capital gains on the difference. You can put as much money as you want in these variable annuities and guaranteed investment protection rider, and the money that accumulates in these accumulates tax deferred. Okay, and then when you die, if you die, the money in here goes to your heirs at a stepped-up basis. It's extremely efficient and it asset protects. So if anybody tries to steal your stuff, they can't get to the asset. Guaranteed future income annuity, you can put as much as you want in it, and you can deduct up to 2/3 of the $100,000 tax-free. So you only pay 30% on the 100 grand, so 30 grand is where you pay the tax. Because the IRS said that you already paid for it in after-tax money, and basically the money that you're receiving, part of it is basically the return of basis that you're getting. And then you can invest in these fixed annuities and then real estate and business. How much time do I have? Okay, I gotta get to the movie quick. So the last model is your grandparents, your parents, and yourself at some point in time are going to accumulate business interests, private stocks, public stocks, real estate, other assets. These assets are either going to be in a living trust or in an irrevocable trust. Okay, these are the questions you need to ask your parents when you go back on your break for the Christmas break. Where's the money? Am I on the stock brokerage accounts? Who's on the title? Who's on the insurance policy? Who's on the who's in the trust documents? Because if you're not in it, you're out of it. Okay, nobody's going to give you the money. I've seen it. I've seen wives, I've seen husbands, I've seen uncles, I've seen kids basically steal the money from their heirs, from their siblings. So if you don't know where the money is, you're not going to get it. Okay, you may not get it. So you got to know where it is. So first thing is you're going to stick assets in a living trust, either partnerships or other things that you can't put into an irrevocable trust. Why would you put money into an irrevocable trust when you're 70, 80 years old? Because the assets are going to pass to your heirs at a stepped-up basis, where they don't pay any taxes. Okay, and if you do pay taxes because you were pushed into the estate tax realm because you have too many assets, you get life insurance to pay not only the mortgage and the debts from the ones inside the living trust and inside the irrevocable trust, but the death benefit is going to pay off the taxes and pay off the mortgage and transfer the assets to you, the heirs, debt-free, tax-free, and at a stepped-up basis.
You can also avoid all the tax of the generation gap.
Yeah, and it's like, thank you, Dad, thank you, Mom, thanks, grandparents, thanks for doing that stuff for me. And then your kids will say thank you too, okay, for doing that. Because I don't know about you, but I love taxes. I don't know about you, but I love taxes. I love to pay taxes. I love to pay income taxes between 39 and 70%, both state and federal taxes. I love local taxes too, particularly assessment taxes and retail sales taxes. I love that. I love capital gains taxes, I love recapture taxes because I've been depreciating my real estate for the past 30 years. I love the transfer tax that the county slaps on me when I trade my real estate. I love retail tax, and I just love taxes. If you love taxes, don't do anything. If you hate taxes, you gotta start planning. You have to start having some really serious conversations with your parents and your grandparents. You need to have those conversations now. If you don't, you're not gonna get it. You think you're gonna get it, you're not gonna get it, okay? And then lastly are the trusts, okay? First thing is you need a will, okay? You should have a will, your parents should have a will, your grandparents should have a will, and there needs to be a medical directive in it that basically states if something happens to me catastrophically, and I'm hooked up to a machine in some hospital somewhere or some facility, and I'm draining all of our wealth to pay for the medical expenses, pull the plug, okay? Pull the plug. So you need the medical directive within the will. That's the first thing to get. Then if you have assets, you need a living trust. That'll circumvent probate, okay? And it makes it clean. Everybody knows exactly what they're gonna get, okay? If you don't have a will, if you don't have a trust, there's gonna be a battle going on, and you're probably gonna lose, especially if you have older siblings, or you weren't directed, by the heir apparents that you were the person that's gonna run everything. If you are, it needs to be in writing, okay? There are irrevocable trusts, dynasty trusts. Oh, these generation skipping and dynasty trusts, these are the best, because you get a call on Saturday morning, oh, hi, Mom, how are you? Oh, yeah, I love you too. What? You're what? Yes, honey, we've decided that we're gonna set up a dynasty trust and a generation skipping trust, and we're gonna give all of our money to your kids, and you get nothing because you guys are so successful. That's a good one to get. And then charitable remainder trusts, a lot of the rich people use these to pull out a lot of the bases out of their appreciated assets, and then intentionally defective trusts are used, and different permutations are used by people from foreign backgrounds that maybe have a green card or semi-US citizens, or maybe married to foreign citizens, to be able to set up trusts within the United States using international law. All right? So that's all I got. I'm going to put on the movie. I hope you enjoyed the class and the presentation. I'll always be available here for you. Just let me know what I can do for you. And when I put on the movie, you can fill out the rest of it, and then you can give me your deliverable free. And don't forget to eat lots of pie and stuff.
on, please. Thank you.
I can't figure out the sound.
Is it a DVD?
Yes.
Is there a DVD player in the?
Yeah. That's already printed. How do you know? Thanks.
This is like the end of capitalism. This is like the Dark Ages all over again. I don't talk to that. Okay, I love you too. Send your money. She says I need to be on Xanax and double my doses.
I asked Minister and surprised our shorts. They tell me the CDO still have
Fucking insane. You realize that these people are punks and they should be in prison. Look at the data that you can see that the CDOs are worth zero, so you know what they're doing, huh? You know what they're doing, right? Yeah. They're selling the dog shit CDOs, then they go to another bank and short the shorts so that it's all
This is a massive story.
the ones that they buy. You don't understand.
Yeah, I know. I mean, it worked for me.
That's a perfect title.
Right now, everybody in town.
No, I wasn't.
Yeah, and so that's why that in mind, probably because of them. Why? Just because of the
Two guys in a garage band hedge fund that thinks it's the apocalypse.
Thought you was for real, Casey. You know, I have to say I really did.
Try being brutal with a 3-year-old in a white mess.
Oh.
I'm not gonna burn my reputation while lunch.
Yeah, I'll take them.
Wow.
It's totally fucking awesome to see.
Yeah, Casey, I've always hated you because you are a prick in college. You are a prick today.
Some private lots, fellows, but how's it?
Sorry.
Yeah. Yeah. Yeah, I'm having problems with anybody selling. Thing I'm trying to show again. Yeah, because the sound's coming out. It's not coming out. Yes.
I'll just take the darkest one.
Yeah, I'm gonna show the movie 30 minutes. The sound never happened.
Because we're on the street, is that kids are walking heavy losses. The premiums on the swap needed to extend his profit to cover his jewelry shorts. He sold a lot of A and AA swaps as protection. But he believed that there was no way. Tell me Morgan Stanley doesn't hold the contracts on these swaps. Shit. All this time I've been trying to figure out who I'm betting against. It's Morgan Stanley. Which is me. What's your exposure to that million? Please don't tell me it's worked out. Yes, you can answer that because I walk in here and people are crying in your home.
Did everybody pick up their stuff?
To tell me everything's fine and everything's
Everybody return these?
What is happening?
Oh, yeah, I'm not an example for you.